partnership and limited liability partnership. So what is partnership? We have to first define it. So this is when two or more people come together to trade. Okay. So the partnership is treated as a single entity, but it is owned by two or more people. So this is similar to the sole proprietorship style of trading, but this time around, it is not being owned by one person or operated by one person. It's operated by numerous people. It is also different from the company style, where many people have contributed resources to establish a business. In that here, the ownership is not in shares. The ownership is not separated from the management. It is the same people who are operating it. For taxation purposes, each partner will be treated as a sole proprietor, meaning that the money that the partnership makes will be allocated to the partners and then they will be assessed individually. Okay. So the allocation of the trading profit or the trading losses will be divided among the partners according to their arranged profit sharing agreement. So if there are three people, you have Yusuf, you have Gina, you have Benjamin, and you decide that you're going to share the profit equally. That is arrangement, the partnership arrangement when the business was being set up. Any profit or loss that arises will be allocated in that manner. Partners may also be entitled to salaries and interest on capital. Okay, so when that happens, those payments to the partners must be deducted from the profits to arrive at the adjusted profit before the allocation or the splitting is done based on the profit sharing ratio. Okay, so if you look at this illustration, Peter has been in partnership with Paul for many years. The partnership tax adjusted trading profit is 120,000, meaning every necessary payment to whoever is entitled to, be it Paul or Peter, salary, interest on capital, or what have you, has been netted. The partners share their profit equally. So we are supposed to calculate Peter's and Paul's share of the tax adjusted trading profit. Okay, so if you have the tax adjusted trading profit to be £120,000, Peter's share will be, because they're sharing it equally, it will be 50% times the 120,000, which will give him £60,000. Paul will also be the same, 50% of 120,000, giving us £60,000. Okay, you can also do it 1 over 2 times 120,000. It will be the same. Okay, so let's look at this illustration. Kanda and Panda are in partnership. The trading income was £18,000. Profits are shared between Kanda and Panda in the ratio 3:2 after paying salary of 3,000 to Kanda. We are supposed to calculate Kanda's share of the residual trading profit. So the trading income was £18,000 and there is a salary being paid to Kanda. So we have to take the salary out, which is £3,000, which will result in an adjusted trading income of £15,000. Now, this is what is going to be splitted among the partners. They say the Kanda and Panda, and they have stated a ratio 3:2. So the first partner to be named will be allocated a profit based on the first number in the ratio. So if you have Kanda and Panda, and the profit sharing ratio is listed as 3:2, meaning that the 3 will be allocated to Kanda and the 2 will be allocated to Panda. If there are 3, the numbers will be stated in 3, that is the ratio. So the first partner to be named will have the number that is firstly placed in the ratio. The second partner coming in will also be allocated a second number that will determine how much profit or loss that they will get. So with the third. So if you're supposed to calculate the share of the residual profit or the tax adjusted income for Kanda, the total here is 5. So for Kanda, it will be the total adjusted trading income, which is the 15,000, times her profit sharing ratio of 3, divided by the total of the profit sharing ratio of 5. So this is going to give her 9,000. If you want to look at that of Panda, that will also be 15,000 times 2 over 5. So if it's objectives, once you have calculated that of Kanda, the difference of the 15,000 and the 9,000, which is 6,000, automatically will be for Panda. So if it is the rating side, it will be here profit sharing ratio of 2 divided by the total or the sum of the profit sharing ratio multiplied by the adjusted trading income or the residual trading profit. Let's look at the situation where in the course of the year, the profit sharing ratio changes. Okay, so they begin the year agreeing to a certain profit sharing ratio. Let's say Kanda and Panda agree to 3:2 from the start of the year. Let's say it began on 1st January 2024. So let's say when they get to the middle of the year, 30th June 2024, they decide to share the profit equally or to give more ratio to Panda. Maybe he increased his share of the contribution. Okay. What you do is that you have to time apportion the profit based on the period where the changes occur. So if they begin the year, let's say 1st January 2024, with a profit sharing ratio of let's say 3:2, and then on 1st July 2024, they decide to share the ratio equally, let's say 1:1. This is 6 months apart. So when you have the income for the partnership, let's say it is 100,000, you also have to equally split the 100,000 into 2. So they will share the ratio 50,000 here. They'll share the ratio 50,000 here. If it is 7 against 5, the same thing will happen to the profit sharing ratio. Okay. So if you look at this illustration, Peter has been in partnership with Paul and Claire. Peter resigned as a partner on 1st January 2024. The partnership tax adjusted trading profit for the year ended 5th April 2024 is £120,000. The partners always share profit equally and continued to do so after Paul resigned. What will be Peter's, Paul, and Claire's share of the tax adjusted trading profit? The account is always prepared to the end of the year, 5th April 2024. Now, Paul resigned as a partner on 1st January 2024. So the period will be split into 2. From the beginning of the year, which is 6th April 2023, okay, to 31st December 2023, which will give you 9 months. So the profit will be 90,000, which is the 120,000 times 9 over 12, right? Here they are being told that the profit is split equally. So for Peter, it will be £30,000, which is 90,000 times 1 over 3. Okay. The same for Paul, which is 30,000. That is the 90,000 times 1 over 3. And same for Clay, 90,000 times 1 over 3. Okay. When we come to the second period, which is from 1st January, where Paul was no longer part of the partnership. So it's 1st January 2024 to 5th April 2024. The profit that was available will be 30,000. Okay. That will be the 120,000 times 3 over 12. So the share was also done equally between the remaining partners. So the remaining partners were Peter and Claire. So the 30,000 split into two is 15,000 pounds, which is 30,000 times 1 over 2. Paul was not part, so he will have none of it. The same figure will be for Claire, 30,000 times 1 over 2. So the total share of profit for Peter will be 45,000 pounds. For Paul will be 30,000 pounds. For Claire will be 45,000 pounds. Let's look at this illustration. So Doug and Rob are in partnership. The trading income for the year ended 31st March 2024 was 18,000 pounds. Up to 31st December 2023, profits were shared between Doug and Rob 3:2 after paying their salaries of 3,000 pounds and 2,000 pounds per annum. From 1st January 2024, profits were shared 2:1 after paying their salaries of 6,000 pounds and 4,000 pounds per annum. So you're supposed to show how the allocation of trading profits for the accounting period ended 31st March 2024, and also show the partner's individual total profits that has been earned. Okay, so when we come to the profits, a year that is ending 31st March 2024 will begin. So 1st April 2023 and end on 31st March 2024. Great. And here we are told that the profit for the entire period, okay, is 18,000 pounds. Now within this year, there were some changes up to 31st December 2023. So it means that from 1st April 2023 to 31st December 2023, that is 9 months, the profits were shared between Doc and Rob. So here, what we do is that you pick the allocated profit. Okay, so the allocated profit will be 18,000 times 9 over 12, giving us, okay, so we get 13,500 here. Now, there were salaries paid. Dog was paid a salary of 3,000. So this time around, so we have to prorate the 3,000 salary that has been paid. Okay, so the 3,000 times 9 over 12. The 3,000 was supposed to be for the full year, but 9 months through the year, there were certain amendments made. So we also have to prorate the salary. So 2,250. That of Rob, that is also 2,000. Her salary was 2,000 pounds. Prorated for 9 over 12 will give us 1,500. So the adjusted trading profit for the period, 9,750. So this is what the partners will finally be entitled to share. Okay, so the question is asking us to show their individual total profit. So for this period, the partners individual profit, okay, for Doc and Rob, their salaries for this period for Doc was 2,250, for Rob was 1,500. When we come to the profit, okay, their profit sharing ratio for that period was 3:2. Okay, so for Doc, it's going to be 3 over 5 times 9,750. Rob is going to be 2 over 5 times the 9,750, giving us 5,850. What about Rob, please? 3,900. So if we add these two, we're getting 5,400 for Rob. Okay. For Doc, 8,100. For the total for the period. Okay. Let's now come to the period from 1st January 2024 to 31st March 2024. Okay. The profit that will be shared here, okay, will be 18,000 times 3 over 12. Okay. 4,500. Okay. The profit for the period is 4,500. Salaries for Doc, we're told that he was supposed to have been paid 6,000 when they made amendments. He was supposed to have received 6,000 for the entire year. So it will be the 6,000 now prorated for 3 over 12, 1,500. Then we come to Rob. Hers was supposed to be 4,000, also times 3 over 12, 1,000 pounds. So that adjusted trading profits is going to give us 2,000. 2,000 pounds. So when we come to the partners, for Doc, he had a salary of 1,500. Okay, plus a profit sharing ratio. The profit was 2,000. So we were told that the profit sharing ratio is 2:1. So it's 2,000 times 2 over 3. 1,333. Okay. So the total will be 2,833. Okay. When we come to Rob, Rob's salary was 1,000 pounds plus 2,000 times 1 over 3. So 667. So put together, I'm supposed to get 1,667. Okay. So the total income that they are supposed to earn for annual earning for the partners, Doc will be 8,100. This one earn 5,400. Then we add the 2,833 to it. Then we add the 1,667. Okay, we add the 2. So this is supposed to be 10,933. It's supposed to be 7,067. Let's move to capital allowance. So it will be deducted from the income that is achieved, the same way we calculate for the sole proprietorship or the income from self-employment. Whatever income that the business records or earns, any necessary expenditure will be deducted from it. Then capital allowance will be taken from it. The residual amount will now be split among the partners. So if the asset is privately used by any partner, that portion will not be included in the computation. Okay. So in an illustration, Peter has been in partnership with Paul. The partnership's tax adjusted trading profit is £120,000. Now this figure is before the capital allowance was deducted. The capital allowance for the period are £20,000. The partners share profit equally. So we are required to calculate Peter's and Paul's share of the tax adjusted trading profit. So the profit that was recorded by the partnership is £120,000. We have to take out the capital allowance of £20,000. Okay, so the adjusted trading profit is £100,000. So this is what the partners are going to share. So for Peter's share, it's going to give us £50,000, which is 1/2 times the £100,000. That of Paul will also be £50,000, which is 1/2 times the 100,000. Let's look at the basis of assessment for the partnership. So this is the same for the sole trader. They calculate their profit to the end of their accounting period. The tax year in which their year end falls in will determine when the tax will be calculated. So the profit will be splitted between the partners for the accounting period. Okay. Then the individual partners will be assessed within the tax year separately. Okay. So just like the sole trader, every question in the exams will either have a year ending 31st March or 5th April. So the partners will be taxed like sole traders on the tax adjusted trading profit that they share. So it's not like the business's profits will be taxed and then the residue will be shared for the partners. No. So here, when a new partner joins partway through the year, the profit will be split between two periods, like we did. Okay. So the first one that we did, we realized that Paul exited halfway through the year. The same thing can be done if the two of them had started and Paul joined halfway through the year. We split the profit into the periods where the partnership had changed. And then we determine the profit that is accessible. Okay. So when an old partner also leaves halfway through the year, the same thing will happen. The profit will have to be split between the two periods and then allocated to the partners. So the period one, the profit will be assessed, will be allocated. The period two will be the same. The sum will be made and then assessed in the tax period. Now, when there's a partner leaving or joining, once there is a common partner in the business, the partnership will deem to be continued. So if you have Gina, Paul, John, and Ben, and some are leaving, some are going, and Gina still remains, there shouldn't be a point where the partners that started the business, none of them is still in the agreement, or none of them is still in the entity. One must stay. The moment all of them leave, the partnership will dissolve. Okay. So let's look at this illustration. Anne and Beryl have been in partnership since 6th April 2021, making up their account to 5th April each year. Now, on 6th April 2023, Claire joins the partnership. The partnership's trading profit is as follows. So, the year end to 5th April 2022, the profit was £12,000. The year end to 5th April 2023, the profit was £14,000. The year end to 5th April 2024, the profit was £24,000. The profits are shared equally between the partners and then they are allocated to the partners. Okay. So if we are supposed to determine how this profit will be shared to them and then determine what they are supposed to, the profit that they are supposed to pay. You have Anne, Beryl, and then Claire. So for the year end, 5th April 2022, we are told that they share the profit equally. So if you look at the question, the partnership began on 6th April 2021. So 1 year later will be 5th April 2022. And we're also told that on 6th April 2023, Claire joined. So it means that for the year ending 2022 and 2023, there were only there was only Anne and Beryl in the partnership. And if they are sharing their profit equally, it means that Anne is going to get £6,000, which is a 12,000 times 1 over 2. The same for Beryl, which is £12,000 times 1 over 2. Nothing for Claire. When we come to the year end, 5th April 2023, Claire was still not in the picture. The total profit was 14,000. So £7,000. That is 14,000 times 1 over 2. Beryl 2 will be the same thing, 7,000, which is the 14,000 times 1 over 2. Clear nothing. However, when we come to the year end, 5th April 2024, Anne's profit will be 8,000. So it's 24,000. This time around, it's going to be 1 over 3 because Claire had joined the partnership. Yes. So because they are sharing profits equally, it will still be 8,000 for Beryl, 24,000, 1 over 3. Claire will now have 8,000, 24,000 times 1 over 3. Okay. So for the year ending 5th April 2024, the tax year, Anne will be assessed on a profit of 6,000. Beryl will be assessed on a profit of 6,000. Nothing for Claire. For the year ending 5th April 2023, the tax year will have Anne being assessed on a profit of 7,000. The same for Beryl. When it comes to the tax year 2023-2024, Anne, Beryl, and Claire will all be assessed on a profit of £8,000 each. Let's look at partnership losses. So the same way profits are allocated between the partners, losses will be done in that manner. So loss relief claims will be available to the partners the same way it was for the sole traders. So it can be carried forward to be offsetted against trading income in the following year, offsetted against total income in the current year, and capital gains, and then can be taken back 12 months in the previous year and offsetted against total income and possibly capital gains. Now, a partner that joins the partnership may claim an open year relief. So, if a partner, let's say, like the previous example that we solved, the two partners had been operating for 2 years before the third one joined. So, when Claire joins on 6th April 2023, it will become the first period that she's joining. So, it will be treated as if she has started trading afresh. So any loss she makes within the first 4 years, she can claim an open year loss relief. But the old partners will not enjoy that relief. Okay. Now, a partner that is also leaving can claim a terminal loss. So you don't have to wait for the entire partnership to fold up before a terminal loss can be claimed. Partners that are not exiting and that are remaining, the fact that one person has exited the partnership doesn't mean that the partnership is ceasing to operate. So they will be excluded from claiming the terminal loss relief. So let's look at this illustration. So John, James, and Paul are in partnership making up the account to 5th April. During the year, Paul left and George joined the partnership. The partnership made a trading loss of £40,000 during the year. Let's state the loss relief claims that will be available to the partners. What will be the situation for John? What will be the situation for James? What will be the situation for Paul and for George? We are told that John, James, Paul were in a partnership. in the period to 5th April. So let's say the 5th April that we are talking about is 2024. So they will begin 6th April 2023. Okay. Now they've all made a loss. They will be entitled to a loss. Let's forget about the amount because it's a loss. So everybody will be entitled to a loss. Now, from what we learned, the opening year relief, when a new partner joins, okay, he will be deemed to have incurred a loss within the year. So he will be entitled to an opening year's relief. Of the four partners, it is George that joined within the year. So George will be considered to have started the business afresh. So George will be entitled to an opening year relief. So let's say everybody's loss is £10,000 each. George will be able to send the loss, okay, will be able to send the loss 3 years back to offset against any profits that they make in the first in, first out basis. Now, Paul also left the business, so Paul will be entitled to a terminal loss relief, okay, where he gets to offset his loss also against 3 years income that was made in the 3 previous tax years on a last in, first out basis. So this one will be a last in, first out basis. This one will be a first in, first out basis. James and John, they can't be entitled to opening year and the closing year because they are still in existence. So they can take it forward into the following year. Or if they have other income, like you are saying, if they have employment income, they have self-employed income, they can try to offset it against it. Or take it back 12 months previously and offset it against any total income that exists.